Welcome to TalkTickers. We're here to, boil down complex info like earnings calls into what really matters for you.
And today we're digging into MDB Capital Holdings, their recent Q1 2025 call, specifically.
Right. We'll cover the results, their strategy, the outlook.
Yeah, the whole picture. Our mission, as always, is to cut through all the noise from the full call.
Exactly. We want to pull out the absolute key nuggets, the most important bits, so you get a clear picture of where MDB stands and where they might be headed.
Okay, let's kick things off with a quick snapshot. The financials for the quarter.
How did they look?
Well, net current assets decreased. It was by about $2.3 million.
Okay, $2.3 million down, which, if you think about it, means their actual cash use, it was pretty low.
Yeah, exactly. Less than $2 million cash utilization for the whole quarter.
Okay. That's definitely worth noting. And deals, how many got done?
Just the one financing closed in Q1. That was the Heartbeam deal.
Only one. That sounds maybe a bit slow.
It could seem that way, but they did talk about the pipeline.
Ah, okay. What's in there?
3 new letters of intent, LOIs, already lined up, apparently.
So activity brewing. Got it. What about their shareholder base? Any changes there?
A modest increase is how they put it. New accounts onboarded.
Anything specific?
They did point out that quite a few smaller investors came in through that Heartbeam offering.
Okay. So wrapping up the quarter, lean on closed deals, yeah, but cash burn was low, pipelines building with those LOIs, and some new, smaller shareholders joined.
That's a fair summary. So let's unpack their core strategy now. They keep talking about public venture capital.
Right. What does that actually mean when MDB does it?
It's essentially their model for finding companies they think have, well, huge potential for returns. They call it asymmetrical return potential.
Okay, big upside potential.
Exactly. But crucially, they do it in a way that gives investors liquidity through the public markets.
Ah, okay. So not locking your money up for years like traditional private venture capital. You get the high growth potential, maybe, but you can trade the stock.
That liquidity piece is really the key difference they stress. And their goal is to take these, sometimes complex or uninvestable big ideas.
Uninvestable in the private markets, you mean?
Yeah, maybe too early, too complex for traditional VCs.
Yeah.
And structure them so they can work as public companies.
Interesting. How do they actually do that? They've built a platform, right?
They have. And a key part of that is PatentVest.
I remember that name. Is it just like a law firm helping with patents?
Not quite. Think of it more like a strategic partner. It helps the companies refine their whole business model, their IP strategy, how they position themselves in the market.
So before they go public?
Yes, exactly. It's all about getting them ready, making them, more understandable and attractive for public investors. It guides them.
Okay, so it's much more than just legal paperwork. It's shaping the company itself. That makes sense. What else is on this platform?
Well, their broker-dealer arm is obviously crucial. And the big news there is it's now a clearing firm.
A clearing firm. Why is that such a big deal?
It gives them a ton more control and flexibility over the whole IPO process, especially now when markets are tough.
How so?
Well, they don't have to rely on external clearing firms who might be hesitant or expensive in volatile times. It just smooths the path to take these companies public when it might be difficult for others.
Right. That flexibility is key in this environment. And they mentioned something about building a community.
Yeah, an investor community. They're trying to cultivate this network of investors who actually understand this specific public venture approach and are looking for these kinds of deals.
Got it. Okay, let's zoom out a bit to the broader market picture. They seem to describe it as challenging for small public companies, but also kind of an opportunity.
Exactly. It's a bit of a paradox they painted. Despite all the headwinds, they genuinely feel it might be the best time in like 20 or 30 years to find really good ideas at better valuations.
Why now? What's driving that?
It's this huge logjam. All these private companies, funded by venture capital over the last few years, especially post-COVID, they haven't been able to exit.
Right. I remember them mentioning some carded data on that. It sounded pretty stark.
It really was. Thousands of companies funded, but hardly any exits. The specific stat was only 15 IPOs since 2018 from the 4,300 companies funded just in that year.
Wow. Only 15 out of over 4,000. That's a tiny fraction.
It really shows the pressure cooker that private companies and their VC backers are in. No easy way out right now.
And that pressure, it leads to, what was the term they used? A valuation mismatch.
Yes. Because exits are so hard to come by, These venture firms and the company founders, they're becoming, let's say, much more open to potentially lower valuations in the public market.
Compared to what they might have hoped for a few years ago.
Definitely. The alternative might be nothing, or, taking a really painful down round privately, which nobody wants.
So the companies needing an exit are more flexible on price. What about the investors? What are they looking for these days? Has that changed?
Oh, significantly, according to MDB. The market appetite has shifted away from what they call green bananas.
Green bananas, meaning very early stage, needing lots more cash down the road.
Exactly. High dilution risk, long timelines to potential revenue, let alone profit. Investors seem less patient for that right now.
So what do they want instead?
Companies that are, closer to actually selling something, commercial reality, business models that don't need endless cash infusions, capital light, and importantly, a clearer path to profitability, maybe even already profitable.
That sounds like a pretty fundamental shift in taste. So how is MDB adapting to this? Are they changing their approach?
That's the core of their strategic pivot. They're not totally abandoning the deep tech stuff that's kind of their heritage.
Right.
But they are actively curating their pipeline now. They're looking for deals that specifically meet these new market demands.
Including profitable companies.
Yes, explicitly. Which, as they noted, is sort of a throwback to how things were decades ago, before the massive tech boom shifted focus solely to hyper growth.
Interesting. So adapting the supply of deals to meet the current demand makes sense.
Right. And their underlying belief, their thesis, is that this pivot, combined with all those private companies desperate for an exit, it could actually spark a pretty robust market for small cap IPOs again.
Potentially reversing that long decline we've seen in small IPOs.
That seems to be the hope, yeah. A bold call, but that's their view.
They also talked a lot about their track record. That 17 for 17 number came up, taking companies public. Why is that so important to stress right now?
Well, think about it from the perspective of a founder or a VC stuck with a portfolio company. Seeing that MDB has consistently gotten companies public 17 times in a row.
It gives them confidence, certainty.
Exactly. It provides a level of certainty about execution that's incredibly valuable when exits are scarce. It makes those founders maybe more willing to accept MDB's valuation terms because they believe MDB can actually deliver the IPO.
Right. It de-risks the process for them.
Precisely. And they also mentioned broadening who they talk to on the investor side.
Moving beyond just deal buyers.
Yeah, focusing more on what they term capital allocators. Think angel investor groups, registered investment advisors, RIAs, family offices.
People looking to build a portfolio over time, not just jump in and out of one deal.
That's the idea. Building longer-term relationships with investors who understand and want exposure to this public venture asset class.
And they commissioned some research to help explain this asset class.
They did. A report looking back at their 17 historical IPOs, analyzing different investment strategies.
Like buy and hold versus something more active.
Yeah, they looked at buy and hold, a balanced approach, and active management. And they shared some IRR numbers, internal rate of return, 49% for the balanced strategy, 44% for active management.
Those are pretty eye-catching numbers. What's the goal of sharing that?
It seems twofold. One, to show potential investors how they might think about investing across multiple MDB deals over time. And two, to really hammer home the advantage of liquidity.
Compared to traditional VC.
Right, where your capital might be locked up for, 7, 10, even more years. With these public listings, even with volatility, you have the option to access your capital much sooner if needed.
Shorter time horizon, potential access to capital, demonstrated historical returns. Okay, let's get back to the pipeline. They said it was thick. What kinds of deals are in there now, especially fitting that pivot you mentioned?
They gave details on 3 current LOIs, which gives us a good flavor. First up, a biotech called PaulX Bio.
Okay, biotech. What's notable there?
The team, mainly. Apparently, they were involved with a company called Prevention, which MGB previously took public and was later sold for $2.9 billion.
Wow, okay. That's a serious track record for the team.
Yeah.
What's PaulX Bio working on?
A potential pill designed to regenerate insulin. Still early stages, obviously, but
Big potential if it worked.
huge. And they framed it around reaching a key inflection point with relatively little capital.
What do they mean by inflection point here? Like a major data readout?
Yeah, something like that. A critical milestone, maybe a key clinical result, regulatory progress, something that could dramatically revalue the company.
And they mentioned a valuation, something like $20 million pre-money.
Right. Pre-money valuation is the company's value before the new IPO money comes in. So $20 million is relatively modest for a biotech with that kind of ambition.
So it fits that capital light to reach a major milestone idea.
It seems to, yes.
Yeah.
Needing a smaller chunk of cash to potentially create a lot of value. That's the first one.
Okay, what else?
Second, LOI, a profitable, fast-growing beverage company.
Oh, interesting. A total shift from biotech.
Exactly. A consumer product, easy for investors to understand, already profitable. And apparently it chose to go public with MDB instead of taking private equity money.
That really highlights the pivot towards profitable, understandable businesses.
It does. And the third one they mentioned, a healthcare software company.
Also sounds more tangible.
Yeah. Growing revenue apparently needs very little capital to hit its next growth inflection points and has significant upside potential.
So, across those three LOIs, biotech, with a known team needing focused capital, a profitable consumer brand, and a capital-light software business, you can really see that strategic shift in action.
It definitely seems reflected in the pipeline examples they shared. And operationally, they said they're handling things well.
Meaning the internal machinery analysts, the clearing firm, back office, it's all scaled up.
Yeah, they stated pretty clearly that the current setup, the current expense level, can handle thousands more investors without needing a major organizational build-out.
So they feel ready for more volume.
Apparently so. And they really highlighted that clearing platform again, seeing it as a major asset, potentially allowing them to add new products or even partner with other firms later on.
Okay. They also mentioned something about executive pay, realigning compensation.
Yes, that was notable. They presented it as a way to make absolutely sure management's interests are aligned with shareholders, especially because the market's been so tough.
What do they actually do?
They converted a significant chunk of restricted stock units, RSUs, into stock options instead.
Okay, so RSUs eventually just become stock, but options are only valuable if the stock price goes up from where it is now.
Exactly. Options have an exercise price. So management only makes money on these options if the share price appreciates significantly. They essentially gave up, I think the figure mentioned was around $21 million in potential value from RSUs, though they noted that wasn't exact,
Wow.
to tie their compensation more directly to future stock performance. It's a way of saying, we don't win unless you, the shareholders, win.
That certainly sends a message in a challenging market. Feels like a commitment. They also touched on how they calculate their own enterprise value.
Right. Simple calculation, they said. Net current assets plus the value of their big idea investments.
Which are their stakes in portfolio companies like Exozymes and Heartbeam.
Correct. They're public venture holdings.
And the point was that MDB's own stock has been trading below that calculated value, a discount.
Yeah, they acknowledge it's been trading at a discount to that enterprise value.
Why would that be?
Partly, they suggested, it's just due to the volatility in the stock prices of those specific holdings, Exozymes, Heartbeam. When those go down, it drags down MDB's calculated value, and maybe its stock price too.
Makes sense.
But also, they feel it's tied to that broader negative sentiment, the bad tape as they called it, for small, early-stage public companies right now. The market just isn't fully appreciating the underlying assets or the potential, in their view.
So a mix of specific stock volatility and general market malaise for this sector.
That seems to be their take.
Let's go back to PatentVest for a sec. You said it was more than a law firm. How critical is it to the whole MDB process?
They described it as absolutely critical. It's not just an add-on. It's fundamental to how they create value.
How does it create value, though? Can you give an example?
Sure. Imagine a company like Exozymes with, say, a complex but potentially groundbreaking platform technology. Great science, but how do you turn that into products people will buy?
Right, the commercialization piece.
It's exactly.
Yeah.
PatentVest steps in with expertise in strategy, business modeling, IP development. It helps them figure out which market should we target first? What's the best go-to-market strategy? How do we build an IP moat to protect this?
So it helps answer those really hard business questions for these often science-heavy companies.
Precisely. It helps transform the raw potential into a structured, understandable business that public investors can actually analyze and hopefully invest in.
Okay, I see how that's critical. It shapes the investment case. They did mention it runs at a loss currently.
Yes, as a standalone entity, it's not profitable right now. But MDB views it as like a necessary cost center that enables their main business finding, shaping, and financing these companies. It's part of the value creation engine.
Is there potential for PatentVest itself to become a profit center or a bigger asset?
They're looking into it. exploring ways to scale its revenue, maybe even spin it off eventually as a separate business. Yeah, they mentioned its unique blend of legal and strategic advice is apparently attracting interest from other professional service firms, like accounting firms. So there might be a future path there, but it sounds like early days.
Interesting possibility. Okay, shifting gears slightly. When we think about MDB's value overall, how much is tied to the current portfolio, Exozymes, Heartbeam, et cetera, versus their ability to just keep finding new great companies?
That's a key question they addressed. They basically said, look, if our past huge successes like Pulse, Q, Prevention had happened while MDB itself was public,
And the valuation impact would have been massive.
huge, potentially near $1 billion, they speculated.
Yeah.
So history shows the model can generate enormous value.
But right now.
Right now, yes, the value perception is heavily influenced by how Exozymes and Heartbeam are doing, but their argument is that the market is underestimating their core capability, finding the next pulses, the next preventions. That pipeline generation is where they see the deep, recurring value.
And do they see anyone else doing quite what they do? Competition?
Their stance was pretty clear. No effective competition doing the whole integrated package.
Really? No one.
Well, they acknowledge other investment banks take small companies public, obviously. But they argue those firms lack MDB's deep curation, the value add from PatentVest, the focus on building that community of long-term real investors rather than just flipping IPOs.
So it's the combination of curation, strategic help, and investor relations they see as unique.
That's the argument. They believe that integrated platform is their real differentiator.
Okay, let's try and synthesize this. For you, the listener, what are the key takeaways here? What does all this mean?
Well, first, it positions MDB as offering a distinct investment strategy, this public venture capital idea. It's an alternative way to potentially get exposure to early stage growth, but with that crucial difference of public market liquidity.
Contrasting with traditional illiquid private venture.
Right. And second, it highlights how MDB sees opportunity in the current market because it's challenging. They're leveraging the pressure on private companies to secure potentially better valuations, and they're pivoting their deal selection towards what investors want now.
Like those profitable or capital-light companies, they're trying to capitalize on these specific market dynamics.
Exactly. And then there are the potential catalysts you'd want to watch based on the call.
What are the big ones?
Near term, that potential Heartbeam FDA news seems significant. Progress with Exozymes, particularly the NCT opportunity they mentioned. Closing those 3 new LOIs, Paulax Bio, the beverage company, the software firm.
Getting those deals done would validate the pipeline.
For sure. Plus, continued growth in their investor community, especially those capital allocators. And longer term, any real movement on scaling or spinning out PatentVest.
Okay, lots to track there. And underpinning it all, they conveyed a sense of, management commitment despite the headwinds.
Yeah, that RSU to option conversion, the focus on execution. It paints a picture of a team digging in for the long haul.
Let's quickly just recap the status updates on the main portfolio companies they discussed.
Okay, Exozymes. Focused on developing valuable products. That NCT thing is a key near-term value driver to watch.
Heartbeam. All eyes on the FDA, hoping for positive news soon on that 12-lead synthesis software. They see that as unlocking much broader use and value.
Clear sign. Just continuing to execute, scale revenues, build the business day to day, even if the stock price is volatile like many small caps.
And Q. Still tough market for biotech.
Yeah, tough biotech tape. They've partnered in autoimmune, but the underlying potential of the platform modulating the immune system for cancer or autoimmune diseases, that potential remains the core story there.
How did the CEO frame the stock discount overall? Did he seem concerned?
He acknowledged it, but framed it as largely cyclical. A market perception thing tied to this really difficult environment for small, early-stage companies. He even drew parallels to some historical examples. Thermal Electrons, Safeguard Scientific, companies that went through similar periods but eventually saw huge appreciation.
So his view is focus on the business, build successful companies, and the stock price will eventually take care of itself.
That was the message. Don't get distracted by the short-term bad tape. Success in birthing these companies is what will ultimately drive MDB's value.
And looking ahead, what are their main priorities now?
Number 1, execute. Get the current financings done, get the next batch of candidates ready to go.
Keep the pipeline moving.
Right. 2, keep expanding that investor community, focusing on those capital allocators. 3, continue curating the right kind of opportunities that fit what the market wants now. And 4, just keep scaling their internal capabilities to support all this.
Makes sense. Execute, grow the investor base, find the right deals, make sure the platform can handle it.
Yeah, they wrapped up expressing confidence in the platform, the team, and their ability to keep finding exciting companies, even viewing these tough conditions as a source of opportunity.
Okay. Now we're heading into a segment that needs a very, very clear warning label.
Absolutely. Huge disclaimer time. What we're about to discuss is not financial advice. It is purely a hypothetical thought experiment.
A wild yet plausible idea, maybe, based only on the specific points we just covered from MDB's earnings call.
Do not take this as a recommendation to buy or sell anything. Seriously. It's just connecting some dots from the call.
Okay, disclaimer delivered. So purely based on what we heard, MDB trading at a discount to their own calculated enterprise value.
Their holdings in Exizymes and Heartbeam, with Heartbeam having that potential FDA catalyst coming up.
The strategic pivot towards potentially more attractive, maybe profitable or capital-light companies.
And the CEO's stated belief that success in the portfolio companies is what will ultimately drive MDB's own stock price.
Okay, connecting only those dots, what's the hypothetical idea?
You could theoretically consider a relative value trade.
Okay, explain that. Betting on one thing versus another.
Exactly. So the hypothetical trade structure would be, step one, go long MDB Capital Holdings. Buy MDB stock.
Okay. Long MDB. What's the other side?
Step two, simultaneously go short. Maybe a basket of other recent small cap IPOs that seem less curated. Maybe you're still deeply unprofitable, struggling in this bad tape.
Ones that don't have MDB's specific platform or curation.
Right. Or if you wanted to broaden the hedge, maybe short a general small cap index or conceptually a traditional VC index, trying to offset general market risk in that early stage space.
So the thesis isn't just MDB goes up, it's MDB outperforms its weaker peers.
That's the core idea. You're betting on MDB's specific platform, their curation ability, the strategic pivot, and those potential company-specific catalysts like Heartbeam.
Giving it an edge relative to the broader, perhaps less differentiated small cap or early stage market.
Precisely. The short position is trying to isolate MDB's potential alpha, making it less dependent on the whole market rising and more about its relative strength and ability to execute in this specific environment.
Interesting hypothetical structure. A bet on their unique model paying off against the backdrop of a tough market.
But again, purely hypothetical, not advice, just an exercise based on the call content.
Understood. So let's just quickly recap the main takeaways from our deep dive into the MDB call.
Okay. They're clearly navigating a tricky market by actively pivoting their strategy, focusing on curating deals potentially profitable, capital light, that align with what investors seem to want right now.
And they're leveraging their unique platform components PatentVest for strategic shaping, the clearing firm for execution flexibility to do this.
Right, while also working to expand their investor base, manage cash prudently, and keep that pipeline moving with opportunities like Paulix Bio, alongside hoping for catalysts from existing holdings like Heartbeam.
Our goal here was really just to distill that hour-long call down to the most crucial insights and context for you.
And maybe leave you with one final thought to chew on, building on everything we discussed.
Go for it.
If this shift, we talked about the market demanding more tangible progress, clearer paths to profitability, commercial readiness from smaller companies. If that's not just a short-term reaction, but a more sustained trend.
Yeah.
How fundamentally does that change the game for early-stage investing overall, both public and private? And in that potentially new landscape, does a model like MDB's, which is explicitly built around curating for public market demands and investor appetite, gain a significantly bigger advantage compared to traditional VC models, maybe still holding on to that backlog of green bananas?
Does this market shift play directly into their specific strengths? Definitely something to think about.